Hey, what's up guys? John here. The average home buyer just lost 25% of their purchasing power due to rising interest rates over the last 6 months. I think we're witnessing the beginning of a shift in the housing market, a very big shift that I think is going to lead to a big market crash and a big opportunity for smart and savvy real estate investors to go out there and acquire distressed opportunities. Now on this channel I talk about personal finance, real estate, business, and money. I've been talking about, this hot real estate market coming to an end. And it looks like this is, happening now. You think about what this means. So a $517,000 buyer that, had the income, had the credit, had the qualifications where a lender was going to step forward and issue the funding to where they could go out there and purchase a $517,000 house. Now they can only buy a property for just under $400,000. Now, what is this going to mean for home sellers, right? It's going to mean more price reductions. It's going to mean less multiple offers. It's going to mean a change in the housing market. Now, home buyers are, they're not calling it quits. They're doing pretty, in my opinion, pretty risky moves right now. They're jumping into adjustable rate mortgages, and demand for adjustable rate mortgages surges as interest rates make the biggest jump in 13 years. Now, why do I dislike adjustable rate mortgages? Well, adjustable rate mortgages bank on the fact that, they're going to be able to refinance their property over the next 5 years or 7 years, depending on the term, or they're going to be able to sell it and get their money back, right? So if they can't sell it, then they're going to take a loss. If interest rates continue to rise and their income does not follow, then they're not going to be able to, refinance that property. And if interest rates, stay where they are, then they're also going to be likely in trouble. So it's a speculative play, and I don't like the idea of speculating on your future. And a lot of people right now are doing this to get into a property. Now, what Jerome Powell just indicated today, about an hour ago, is exactly why I do not like that idea of jumping into an adjustable rate mortgage. Fed Chair Jerome Powell plans to continue interest rate hikes, which he warns could lead to a recession. And he said that he told the Senate Banking Committee on Wednesday that despite the Federal Reserve's plans, a soft landing for the economy will be tough, just like inflation will be transitory, right? This isn't going to be a soft landing. This is going to be a very rude awakening. So we can't fail on that task. We have to get inflation to 2%, and they say that we are at an 8.6% inflation, and it's a 40-year high, a 41-year high, right? And so if they say we're at 2%, we have to get to 8.6%. It's pretty self-explanatory how many rate hikes are likely going to be coming down the pipeline. So if rate hikes continue to rise, what does that mean? That means that home prices will likely continue to fall, especially in the higher end markets above $500,000 to $700,000. I believe that what we're going to see is we're going to see strong support between $200,000 to $400,000 due to institutional capital, private equity firms, corporations, all the money on the sideline looking to allocate capital to, risk adverse assets, which are going to be the entry level housing products, right? People are going to need to live in these properties. They can rent them out profitably, and it's a great store of value. Now, these properties I think are going to see a lot of demand, but the higher end markets, the house flippers, they're going to be in big trouble, because who's going to go out there right now and buy a property that was just recently flipped when you don't know what's going to happen in this economy, right? People are going to start saying, you know what, I'll paint it myself, I'll do the work myself, I can do it down the road, I can do it in 6 months, I just want to get into this community, I don't care what the house looks like. A change in attitude, right? So here's what Redfin just said. Home buyers on a $2,500 monthly budget have lost $118,000 in spending power this year amid a surge in rising rates. A home buyer on a $2,500 monthly budget has lost nearly $120,000 in spending power since the end of last year's mortgage rates have nearly doubled. That buyer can afford a $399,750 home today. Today's mortgage rates are roughly 6%. It's a staggering $117,750 less than the $517,500 home that same budget could have bought at the end of last year when rates were near record low of 3%. To put it another way, the monthly payment on a $399,750 home would rise more than $500 with higher mortgage rates from $1,931 to $2,500. Now it's not just rising mortgage rates. You also have increased insurance costs that are occurring in most markets, increased utility bills, increased costs for property ownership when it comes to repairs. Everything's getting more expensive, right? Nationwide, 45.6% of homes for sale are affordable on a $2,500 monthly budget with 6% interest rates. By comparison, 61.6% would be affordable if rates were still at 3%. That's according to Redfin analysis of homes for sale from May 15th to June 15th, and assumes a 20% down payment, 30-year fixed rate, mortgage 1.25%, property tax base, and 0.5% for homeowners insurance, no HOA, right? Higher mortgage rates are necessary to cool down the red-hot housing market. They're already slowing competition, but they're also putting buyers in a tough spot, said Redfin chief economist Daryl Fairweather. The increase in monthly payments means that many house hunters now have to reconsider smaller homes, perhaps farther from their ideal neighborhood, or stick to renting if they're priced out of their market altogether. And for sellers, small home buyer budgets mean that they can no longer expect to get top dollar for their homes. Rising mortgage rates also impact housing supply, as some would-be sellers may stay put because selling their home and buying another one would mean trading a low mortgage rate for a higher one. Mortgage rates have been on the rise since January as the Federal Reserve seeks to fight inflation. Last week alone, the 30-year fixed-rate mortgage climbed to 5.78% from 5.23%, the largest one-week jump since 1987, as Fed introduced the steepest interest rate hikes in nearly 3 decades. Although 30-year mortgage rates have shot up, buyers do have better options. Home buyers can consider adjustable rate mortgages, which typically have lower interest rates at the beginning of the term, but come with risk, as buyers who choose 6% interest rate have the option to refinance in the future if rates fall. You know, they want people to get into these adjustable rate mortgages. I don't like gambling. I'm very risk adverse. I suggest that everyone else really weigh the downside risk with jumping into an adjustable rate mortgage. A very smart person once told me that the difference between a really, really bright attorney and every other attorney is that a bright attorney is weighing the possible downside risk of every single case. The possible downside risk. And they weigh that risk and they make a smart and educated decision based on that risk. If the risk is there and the reward isn't, they're not going to go forward on it. Well, right now, I think that the same mentality should be applicable towards acquiring a property. You really have to weigh the downside risk. And with an adjustable rate mortgage, if you can't take on that risk, then it doesn't make sense to move forward on that transaction. And we're seeing a lot of people just saying, you know what, I'm going to go ahead and do it. You look at the appreciation in a lot of these hot housing markets over the last couple of years. There's no way that we're going to see home values jump 50 or 60% inside 2 or 3 years, and it's going to stay that way for long term. It just what comes up at that type of velocity is going to be coming down. Home buyers have fewer options with 6% interest rates in all 50 of the most populous U.S. metros, but the impact in places where hot home buying destinations during the pandemic: Phoenix, Raleigh, Vegas, Salt Lake, and Austin. In Phoenix, 21.5% of homes for sale from May 15th to June 15th were affordable on a $2,500 monthly budget and a 6% interest rate. By comparison, about 50% would be affordable if rates were still at 3%. That's the biggest gap of the metros in this analysis. In Raleigh, 33.2% of homes are affordable with 6% rate compared to 61.1% with a 3% rate. And in Vegas, 30.7% compared to 56.7%. 11% in Salt Lake for sale homes and affordable with 6% compared to 36.4%. In Austin, 13.6% compared to 38.4%. So what is this going to look like? What is this going to look like? I believe it's going to look like price reductions. That's what I think. People that have a property that they need to sell, they're going to have to likely reduce their prices. We're going to see people that had no intention of selling their property, but maybe their small businesses being impacted. Maybe they simply don't have the same money that they had a couple years ago. Maybe inflation is hurting them or insurance prices are going up. We're going to see people being forced to downsize, and we're going to see more homes coming on the market with price reductions. If you're a home buyer, I think the smartest thing you could do right now is make sure you have great credit, strong income, and a great plan, a great strategy, because I think there's going to be great opportunities coming for the smart and savvy home buyer and smart and savvy real estate investor over the next 6 to 12 months. What do you think about this housing market? Do you think that home buyers losing 25% of their purchasing price is going to relate to price reductions in a lot of markets? Again, I think that the entry-level products are going to probably hang stronger, but if you're looking for a $500,000 or $700,000 house or $1 million house, the difference between going from a 3% rate to like a 7.5% rate, if that's where we end up at the end of the year, is substantial, and there's no way we go there without massive price reductions, because private equity firms and institutional buyers, they're not going to be going out there trying to acquire $1 million houses to turn them into rentals. It's just not going to happen. They're not going to want to take on that type of risk and allocate that much capital for, property in which, they're not going to be able to get the same yield if they were to allocate, let's say, $1 million to go buy 3 houses for $300,000 and rent out those 3 properties, diversify their risk, and have more pricing control. We're going to see the upper end market get hit, I believe, very, very soon. But I'm curious as to what you think. Drop your comments below. Hit the like button. Subscribe here. Also subscribe on my second channel. It's pinned below at the top comment. It's going to be an interactive call-in show this upcoming week. People are going to be able to call in on the phone number. We're going to be able to talk about real estate, the economy, and business. So be sure to subscribe there. And follow me on Instagram, TikTok, LinkedIn, and Twitter up in the banner. If you need help establishing a great credit score, maybe you have some problems, my team is amazing, in-house credit repair team. Go to cashnow.video. If you want to learn about real estate investing, cashnow.video. And if you'd like to get started on YouTube, partner up with me, join cashnow.video. I have a private Discord community with bi-weekly phone calls as well to help support you on your journey. All right, guys, I'll catch you in the next video.